In 2003, Mark Zuckerberg builds FaceMash at Harvard, a site that ranks students by attractiveness and previews his early coding skill. Meanwhile, Cameron and Tyler Winklevoss, Harvard rowers and entrepreneurs, recruit Zuckerberg to build ConnectU, a campus social network pitched in 2003. Zuckerberg delays work while he develops his own site, and by early 2004 he launches the Facebook, which rapidly attracts students beyond Harvard. The ConnectU founders interpret those actions as theft, filing suit that accuses Zuckerberg of misappropriating code and business opportunity in a high-stakes dispute. In 2008, the parties settle, accepting a package reported at roughly $65 million in cash and Facebook stock, closing the headline case. The Winklevoss twins later allege that Facebook manipulated stock valuations, which fuels further litigation and public suspicion about transparency in early deals. Because the settlement combines cash and equity, observers later point to fluctuating valuations as evidence that narrative and money can diverge in Silicon Valley exits. The dispute leaves a lasting rhetorical mark. Zuckerberg becomes synonymous with rapid scale, while the twins embody claims of entrepreneurial theft, a hook journalists return to often. In September 2006, Facebook rolls out News Feed, a real-time stream that automatically shares users' actions, posts, friendships, and likes with their network. The feature increases content visibility because it centralizes activity, and within days, millions of updates begin appearing on people's home pages without explicit consent. Students and privacy advocates respond with mass protests and formal complaints, citing exposure of personal information and unwanted publicization of private interactions. Mark Zuckerberg, then 22 and serving as founder and CEO, posts an apology directly on the site and promises to add privacy controls. The apology diffuses immediate protests but forces product changes, because Facebook must balance transparency with user control to preserve growth. Facebook implements new settings and granular controls over the following months, giving users options to hide or restrict who sees their activity. Meanwhile, competitors adopt the mini-feed pattern, and by 2008 the feed model appears across social networks and media sites as the default engagement interface. Because the feed increases passive content discovery, average time spent and share counts rise, which strengthens Facebook's product-market fit despite early backlash. Outrage gradually fades as users acclimatize and as Facebook refines controls, but the episode establishes a precedent about privacy trade-offs in product design. The newsfeed controversy becomes an early structural fault line for debates over defaults, consent, and platform responsibility that resurfaces repeatedly. In November 2007, Facebook launches Beacon, an advertising program that tracks purchases on partner sites and automatically publishes activity to users' news feeds without explicit consent. Because the service ties transactions to Facebook profiles, private purchases including holiday gifts begin appearing publicly on friends' feeds during the 2007 Christmas season, triggering immediate outrage. Privacy advocates and affected users file complaints, and media coverage highlights concrete examples of exposed gifts, which intensifies pressure on leadership to respond quickly. Mark Zuckerberg, serving as founder and CEO, posts an apology in December 2007 and promises to change default sharing because user trust directly affects adoption and engagement metrics. Meanwhile, class action lawsuits allege unlawful data sharing and deceptive practices, and regulators begin scrutinizing the product's consent model. Facebook discontinues Beacon in 2009 after legal settlements and mounting reputational cost, because continued operation risks wider regulatory intervention and user attrition. The episode forces Facebook to formalize opt-in policies and review data sharing defaults, which shapes later product decisions around privacy and advertising integration. For users and policymakers, Beacon becomes an early case study linking opaque tracking to real-world harm, and it anchors future demands for clearer consent standards. On May 18, 2012, Facebook prices its IPO at $38 per share, an offering meant to monetize rapid user growth and expand operations. Because Nasdaq experiences order routing and matching glitches during the opening, many investors face delayed or failed trades that undermine confidence in execution and market transparency. Underwriters and exchange engineers scramble to diagnose technical faults while media coverage focuses on chaos at the trading venue, which amplifies investor anxiety and headlines. The stock trades sharply lower after early volatility, falling to roughly $17 per share by September 2012 as market sentiment shifts and lockup expirations increase share supply. Investors file class action suits accusing underwriters and market operators of misleading statements and flawed execution, and regulators open inquiries into the offering process. Meanwhile, Zuckerberg, serving as founder and CEO, appears on the trading floor in a hoodie and becomes a shorthand symbol for Silicon Valley's cultural mismatch with Wall Street. The IPO episode forces scrutiny of underwriting practices and exchange resilience, and it reshapes how public listings in high-growth tech companies proceed. In February 2014, Facebook acquires WhatsApp for $19 billion, a transaction premised on preserving the app's independence while gaining its global messaging scale. Because Facebook integrates teams and engineering resources, that promised operational independence narrows over subsequent years as policy and infrastructure links increase. Jan Koum, WhatsApp co-founder and CEO at the time of sale, and Brian Acton, co-founder and former executive, both confront internal tension over product direction and user data policies. The acquisition sets a baseline expectation of autonomy that later corporate decisions will repeatedly test. Koum and Acton ultimately depart, and their exits crystallize broader trust concerns because leadership dissent implies deeper product trade-offs. In 2018, Brian Acton publicly supports the Delete Facebook movement, funding campaigns that highlight data-sharing anxieties and reframe the acquisition narrative for millions of users. Meanwhile, regulators and journalists press Facebook about how message metadata and account links might be used for ad targeting or cross-platform profiling. The episode reduces goodwill around platform consolidation because a $19 billion exit failed to eliminate core disputes over privacy, governance, and long-term independence. In 2015, Facebook launches Internet.org in India, offering zero-rated access that allows users to reach a curated set of websites without data charges. Activists and digital rights groups label the initiative digital colonialism because it offers a limited internet experience tied to corporate partnerships rather than open access. Activists and digital rights groups label the initiative digital colonialism because it offers a limited internet experience tied to corporate partnerships rather than open access. Meanwhile, telecom regulators focus on zero ratings' effect on net neutrality because differential pricing can change traffic patterns and disadvantage non-partner services. The controversy forces Facebook to defend public interest claims and adapt strategy while uptake among low-income users remains contested. In February 2016, India's telecom regulator, TRAI, rules against discriminatory tariffs for data services, effectively banning the zero-rating model used by Internet.org. Because TRAI emphasizes equal treatment of traffic, Facebook's model faces legal barriers and loses momentum among policymakers and civil society stakeholders. Facebook rebrands the product to Free Basics and adjusts messaging, but the regulatory defeat in India signals a wider global resistance to preferential access schemes. Meanwhile, several countries and rights groups scrutinize similar offers, which constrains Facebook's expansion strategy and raises compliance costs. The episode creates a precedent. Regulators can translate net neutrality principles into concrete rulings, and corporate zero-rating plans face enduring political risk. In 2014, a psychology researcher's app collects profile data from roughly 87 million Facebook users, harvesting friend network information through granted platform permissions. Because the app accessed friends' data without direct consent from those friends, third-party reach multiplies user exposure and undermines ordinary expectations of privacy. That aggregated dataset later reaches Cambridge Analytica, which reportedly applies it to build voter models tied to Brexit campaigns and the 2016 US election. The disclosure breaks open when Christopher Wiley, a former Cambridge Analytica employee and whistleblower, goes public in 2018 with documents and testimony linking harvested data to targeted political messaging. Because media scrutiny intensifies and regulators open formal inquiries, then CEO Mark Zuckerberg testifies before Congress in April 2018 to explain platform controls and accountability measures. Congress extracts commitments on API restrictions and audit practices, and Facebook responds by tightening developer access, revoking apps, and adjusting default privacy settings to reduce third-party data flows. In July 2019, the FTC imposes a $5 billion civil penalty and mandates independent privacy audits, signaling both monetary consequences and sustained oversight. The scandal forces structural changes to platform design and governance, but it also widens public distrust and accelerates legislative proposals on data protection while Cambridge Analytica collapses. In April 2016, Facebook launches Live, a real-time video feature that increases engagement because watch time and concurrent viewing metrics spike on major broadcasts. Media organizations and individual creators adopt Live because it removes distribution barriers and records show watch times and shares rise markedly for live streams. On March 15, 2019, a gunman uses Live to broadcast mass shootings at 2 Christchurch mosques in New Zealand, and moderators remove the feed. Because the video circulates rapidly through uploads and private messaging, copies remain online for hours, prompting global criticism of content controls and takedown speed. Facebook responds by pledging investments in automated detection and expanding safety engineering teams to improve real-time moderation and reduce rapid spread. Because algorithmic detection struggles with novel live formats, Facebook pairs machine learning classifiers with regional human reviewers and industry partnerships to trace and remove uploads. Regulators, civil society groups, and victims advocates press for stricter transparency and reporting frameworks because notice and takedown mechanisms prove insufficient. As a result, Live becomes a central example in global proposals and product changes that prioritize speed, auditability, and cross-platform cooperation. In June 2019, Facebook announces Libra, a digital currency project designed to operate on a blockchain and backed by a basket of stable assets. The Libra Association, headquartered in Switzerland, includes founding partners such as Visa, MasterCard, PayPal, and eBay, signaling initial credibility across payments and commerce. Because the project aims to reach billions of users through Facebook's apps, regulators in the United States, Europe, and Asia immediately express concerns about monetary sovereignty, consumer protection, and systemic risk. Hearings in Washington frame Libra as an unlicensed banking system, and lawmakers demand Zuckerberg and other executives justify the project's governance. By October 2019, several key payment partners, including Visa and MasterCard, exit the Libra Association, citing pressure from regulators and reputational risk. Facebook attempts to stabilize momentum by narrowing Libra's scope, rebranding it as Diem, and shifting to dollar-pegged stablecoins with tighter compliance measures. Despite these adjustments, regulatory barriers and partner withdrawals reduce viability, and in early 2022, the association sells remaining assets, effectively abandoning the project. The failure demonstrates how quickly government intervention can stall corporate entry into monetary policy and signals constraints on future large-scale fintech initiatives tied to social platforms. In In 2020, Facebook establishes the Oversight Board, an independent body tasked with reviewing high-profile content moderation cases and funded through a $130 million trust. Because journalists quickly dub it the Facebook Supreme Court, the board attracts scrutiny over whether independence is genuine or constrained by corporate design. Its mandate authorizes binding rulings on specific takedown appeals, while recommendations on policy remain advisory, creating tension between symbolic legitimacy and operational limits. The creation signals Facebook's attempt to formalize governance as platform scale reaches billions of users and existing moderation systems face credibility deficits. The board's most publicized decision comes in May 2021, when it reviews the suspension of Donald Trump after the January 6 Capitol riot. The panel upholds the suspension but criticizes Facebook's indefinite ban as lacking clear standards, requiring the company to specify duration and conditions. Subsequent rulings show internal disagreement and generate debate over whether case-by-case adjudication can resolve systemic problems of scale, bias, and enforcement. Because the board's rulings occasionally contradict Facebook's policies, critics frame the body as outsourcing responsibility without addressing structural design. The episode widens global discussion about independent regulation, because corporate self-regulation appears insufficient for disputes involving heads of state and mass audiences. In 2021, Frances Hodgen, a former Facebook product manager with a background in data science, discloses thousands of internal documents later dubbed the Facebook Papers. The records show company research acknowledging that Instagram use correlates with negative self-image and worsened mental health among teenagers, with 32% of teen girls in one study reporting body image issues. Because the documents indicate that leadership did not fully disclose these findings to regulators or the public, Hodgen positions the evidence as proof of profit being prioritized over safety. The leaks intensify scrutiny already building after past scandals, while journalists and policymakers use the internal research to argue for stricter oversight. On October 5, 2021, Hodgen testifies before the U.S. Senate, answering detailed questions about algorithmic amplification, content moderation, and mental health findings. Senators cite the testimony to demand regulation targeting design choices rather than only takedown policies, which elevates the debate beyond moderation toward platform architecture. Meanwhile, Facebook announces a rebrand to Meta on October 28, 2021, emphasizing investment in virtual and augmented reality rather than existing social products. Observers interpret the timing as a strategic pivot, because the whistleblower episode severely damages trust in the Facebook brand. The controversy establishes Hodgen as a central figure in technology accountability debates and accelerates legislative proposals on platform transparency and child safety obligations. On October 28, 2021, Facebook officially changes its corporate name to Meta, announcing a strategic shift toward building the metaverse, a network of immersive virtual and augmented reality platforms. Chief Executive Mark Zuckerberg frames the rebrand as a long-term investment, with Reality Labs, Meta's VR and AR division, absorbing tens of billions of dollars in research and development costs. Financial reports confirm that Reality Labs lost more than $10 billion in 2021 alone, making it one of the largest losses for any single division in a U.S. technology company that year. Because the rebrand follows weeks of damaging revelations from whistleblower Frances Hodgen, critics describe the move as an effort to redirect attention from regulatory and reputational crises. Inside the company, employee surveys and leaked memos record skepticism that the name change addresses immediate challenges such as misinformation, content moderation, or declining teen engagement. Analysts argue that while Meta's pivot could unlock new markets, the timing suggests an attempt to escape Facebook's entrenched controversies. Meanwhile, investors note that despite the heavy spending, Meta's core revenue in 2021 still comes from advertising on Facebook and Instagram, not VR products. As losses in Reality Labs widen, external observers continue to ask whether the company can overcome its history, or whether the Meta brand will remain inseparably tied to Facebook's shadow. If you enjoyed this, I'm going to be posting a lot here. I would greatly appreciate it if you could subscribe. Thanks for watching.